guys, so we are back now with the next part, okay, which as I told you, we have already done the overview of what are the ratios that we can use. Now, when we talk about ratios, the ratios that we use would be profitability, liquidity, shareholder ratio, and debt ratio. Now, let me explain to you in more detail about what are these ratios all about. So, I'm going to share another screen with you guys because I'm going to write all the ratios and also all my formulas in there so that life becomes easier for you. You can copy it. If you don't intend to copy it, just make sure you take a screenshot or something like that so that life would become easy for you and you would have access to all these ratios, including the formula. Now, so what is the ratio that I'm going to talk about, or what are the ratios that I'm going to talk about now? So, as I have previously said, usually ratio analysis is used to measure the performance of the organization. Why is it important? Because you want to see whether you have been able to exceed or achieve the expectation of all the stakeholders of your organization. So, based on the four categories of the ratio, number one, profitability. Number two, liquidity. Number three, debt ratio. And number four, shareholder ratio. So now, what are all these ratios about? So the profitability ratio, for the most part, or the main focus of the profitability ratio is because is to measure the profitability of the organization, i.e., you are trying to assess the managerial performance of the organization. So here, what we are doing is we are assessing the managerial performance. Now, my question to you guys, what is the managerial performance? The managerial performance is how the company managers has performed in that particular financial year. And at the same time, not only are you talking about how you have performed, whether you have achieved all financial targets relevant to the profitability of the organization. So this managerial performance, oops, my line wasn't supposed to go that way. Here you are talking about how the management of your organization has, right? So what are the ratios that entails the profitability ratio? Okay, so you have the ROCE or the ROE. I don't really have space here, so I'm just going to write it this way. ROCE. Okay, so we will talk about it in more details in a little bit. Okay, just give me some time to explain the remaining. So, what is the liquidity ratio all about? The liquidity ratio is important for an organization because what you are doing or what you are assessing in the liquidity ratio will help to provide important information for the company's supplier and customer. Why is it important to provide information for company, supplier, and customer? Because this supplier and customer would want to see whether the company is in an appropriate liquidity position. Why? Because if the company is in an appropriate liquidity position, means they are able, number one, to provide you goods on credit or make sales on credit. And number two, you have sufficient liquid resources available for you to pay your suppliers, right? So the liquidity ratio, okay, just let me write it here. It is important for the company, supplier, and customer. Why? Because it gives a gauge. Okay, I'm just going to use that word here. It gives a gauge. Gauge on whether your organization has sufficient liquid resources to run day-to-day operations. Day-to-day operations. Guys, remember, every time I write, the best thing for you to do is to follow me and write, because the more you write in class, the easier it is when you are doing your exam. So whatever notes that I'm writing on a separate screen, or whatever additional information that I put on my notes, when you have a copy of it, please remember to add that detail by yourself. A screenshot will not help, because you know what's the reality? Sometimes the screenshot will remain in your screen even until you finish your examination. So please remember to print everything out and write it down. Yeah. Now, the next one, what are the ratios that we will calculate when we refer to the liquidity ratio? So, as I've mentioned before, we are going to calculate, or we're going to learn how to calculate the current ratio, or the acid test ratio. Sorry. So, current ratio and the acid test ratio. Right. Now, for the next one, number 3 will be your debt related ratio. Okay, remember, it's pronounced as DET, debt. B is silent. Okay, just information for you guys. Okay, the debt ratio is important to the financial institution that is providing capital to your organization. So example, the bank will see your debt ratio as very important, because they are going to provide you with additional finance. And at the point where they are going to provide you with additional finance, you need to remember that their most important, or their focus area, would be to see whether your company is financially healthy, whether the risk is within an acceptable level, before they proceed to make another loan to you, right? So this debt information is important for financial institutions providing debt finance to the company, i.e., you know it, banks. Okay, so what are the ratios that will be calculated as part of our debt ratio? Number 1 will be your gearing ratio. Okay, so your gearing ratio, as you know, will be an important part of your debt ratio. And number 2, interest cover. So you must remember, guys, please don't forget, whenever you are calculating your gearing ratio or your debt ratio, remember that debt ratio comes hand in hand with interest cover. All right. Now, moving on to the next part, okay, would be the shareholder ratio. So we have already mentioned the shareholder ratio in the past video. So what is the shareholder ratio, or why do we need to calculate the shareholder ratio? The shareholder ratio is very important to the investors or the shareholder of the company. Why? Because it gives a gauge of how the company is able to provide relevant returns to your shareholders, and whether those returns that you give to your shareholders, whether they are relevant or not. So your shareholder ratio is important for the shareholders of the company to assess whether the returns paid to assess the returns paid. Sorry, full stop. Okay. So what are the ratios that we will calculate as part of the shareholder ratio? I think for the most part, I've mentioned a lot of it previously. Number one, you know it, dividend yield. Number two, earnings per share. And number three, PE ratio. I think this has not been mentioned yet, but I believe that you guys know what it means by the PE ratio. All right, so now let's dive into the detail of this ratio. Okay. Okay, let me see. Now, what we are going to do is, I'm going to give you the details, okay, breakdown in details for each of the ratio that I've mentioned previously. So, I'm going to write it down. Please, if you guys at this point, you do not know how to calculate your ratios, you need to learn how to do this. This is important. This has been tested in all the fundamental ACCA papers up to these papers, your final paper, guys. Yeah, so it would be required by your examiner. Like I said, as usual, you need to calculate all ratios, especially that now there is CBE objective questions. He can ask you at any time, right? So the ROCE, your formula will be profit from operations over capital employed, or PBIT over capital employed. So I hope you guys know how to calculate PBIT. Excuse me. Excuse me. Now, another formula that you can use to calculate your ROCE would be profit margin multiplied by, yes, the asset turnover. So you must remember there are many formulas that you can use interchangeably. Asset turnover. So you must know the combination of what formulas you can use that would give you the right answer, because sometimes not all information is readily available. So you must use whichever information that you have to be able to answer the question. Now, moving on, ROE. So how do I calculate ROE? It would be PAT over ROE is equals to PAT over shareholders fund. Now, what does it mean by shareholders fund? Actually, it is just equity. So you just need to take over total equity, right? Now, for the next one, we spoke about the liquidity ratio. Yes, sorry guys. All people problem. We tend to forget things, right? So as for the liquidity ratio, now current ratio, can you take 1 minute, guys, to think about what is the current ratio information, or what elements do you require to calculate the current ratio of a company? Yes, think about it. I'm going to give you maybe, say, I'll give you 1 minute to think about it. All right. And remember, guys, it's very important for you to know this by heart without needing guidance from anyone, because if you know this, it will be easier for you to approach questions. So, liquidity ratio, you have current ratio, which is your current asset over current liability. The next one, quick ratio, is another name for acid test ratio. It's current asset minus inventory over current liability. Now, can I know, guys, from you, why is it that you have to minus inventory? What is the reasoning for the examiner to less out inventory when calculating the acid test ratio? Think about it. There must be a reason. If not, he wouldn't do something like that. So normally you must understand that the reason the examiner does it is because you want to exclude inventory. The reason is because sometimes inventory can be one of those elements of your current asset that is not actually very liquid. So you want to see the more liquid assets, how will it affect the liquidity of the organization. So you must be careful of that. Quick ratio minus inventory, because inventory is sometimes can be considered as less liquid. Now, the third one, your debt ratio. So your debt ratio, you have the gearing ratio, which I've spoke about it previously. Gearing ratio is equals to debt over equity, or you can use debt over debt plus equity. Now, when excuse me, guys, when is the circumstances where you use debt over debt plus equity? Normally, when you perform a market value calculation, you will use debt over debt plus equity. When you calculate a book value gearing, you use debt over equity. But please bear in mind, this also depends on whether the examiner has given you the guidance. Sometimes it may be book value, but the examiner still wants debt over debt plus equity. So you have to pay attention to the question. Look at what the examiner wants, because you must remember your objective is to answer your question in the way the examiner wants it, not in the way that you want it. All right. For that, you have your professional paper where you can use your opinion to state whether or not that should be done or should not be done. All right. Another ratio that we were talking about was interest cover. So interest cover actually is quite straightforward. So what is interest cover? Interest cover, first of all, the formula to calculate interest cover is PBIT over interest. So what is the meaning of this formula? What am I calculating from this formula? I am actually calculating how many times can I use the profit that I have to pay interest. The more profit I have, the better for my organization, because when I have more profit, I can pay out interest more frequently than I expect. So this one is the number of times the available profit can pay out dividend. All right. Now, as for your shareholder ratio, okay, another word that you can use is investor ratio. Number one, you have dividend yield. What is your dividend yield? Dividend yield is dividend per share over market price per share. What does it explain? It explains that how many percent of your value is paid out as dividend. The higher, the better. And this is expressed in the form of percentage. The next one, EPS. I think this is something that you can relate to. It is PAT. Remember, if you have preference share, you need to minus preference share dividend. Don't forget this, guys. You always forget. I've had students who forget this and lose marks for no reason. Over number of share. When you are calculating your EPS, you need to use profit that is distributable. Profit distributable to ordinary shareholders, not just shareholders. Okay, because your shareholders can consist of preference shareholders and ordinary shareholders, but our focus here is to concentrate on the amount that is distributable to your ordinary shareholders. All right, now moving on, the final one that you have would be the price earning ratio. So for the price earning ratio, the formula will be, so PE ratio, it will be market price per share over earnings per share. Now, what does this ratio means, or what will this ratio indicate? So the higher the PE ratio, it means that the company's future prospect is better. That means the company may have a higher ability to make profits in future and a higher ability to attract business to your organization. So that is what it means by the PE ratio. So normally, the higher the market price per share, the higher your PE ratio. And remember, the EPS is something that is very important to investor. So you cannot say you want to reduce the EPS. So you must try to increase the market price per share rather than trying to reduce the EPS. Right? So if that is very clear, now I think we can proceed to try a question. So please look at your handout. You would have a handout specifically for questions. All right, I'm going to share that screen now. Where is it? I can't see it. All right, found it. Okay, so I just want to remind you, this question compilation has been extracted from the BPP book. So we are going to try to do the question relating to ratio. So please look at this question. Let me see whether you have this question. Okay. For beginners, what you can do is you can try this question. Okay, example number 2. So let's look at this question. I will do it together with you. I will try this question together with you. So bear in mind, whenever you try to do a question yourself, please remember to do all your workings at the side of the question, so that at times where you need guidance, maybe last minute towards your exam, when you start to panic, when you're looking for your lecturer, but your lecturer is very busy or your lecturer is on a holiday, you can look back at your workings and you can work on that, on how you achieve the answer. All right. Now, let's move to this question. I always tell my students, whenever you are doing an ACCA type question, what is your objective? Number 1, please remember your objective is to answer examiner requirement. So what is examiner requirement here? Always to identify examiner requirement, read the requirement first. So look at the required. What is the current year EPS? That's number 1. Number 2, what is the growth in dividend per share? So remember, when he say what is the current year EPS, the formula for EPS is PAT minus preference dividend over number of shares. Here, growth for dividend per ordinary share. So dividend per share formula would be dividend over number of share. Now, if the examiner wants you to find the growth in dividend per ordinary share, what you have to do is you have to calculate DPS at the previous year, compare it with the current year dividend per share, not DPP, DPC, DPS, dividend per share. All right. And then finally, he asks you to calculate the total shareholder return for the current year. So remember, total shareholder return, I'm going to use this short form moving forward when I talk about total shareholder return. Total shareholder return is equals to dividend plus capital gains over previous year share price. All right. So let's now scroll through the financial information to see what has the examiner to say. Now, example 2. Again, I just repeat, this is a BPP extracted question. So Magneto PLC has objectives to improve EPS and DPS by 10%. So this is your objective. You want to try to improve the EPS and the DPS by 10% per annum, right? Now he has given you PBIT, interest, tax. Okay, be careful of the preference dividend. Remember, I told you students normally forget the preference dividend. Now, ordinary shares given and the share price has also been given. Now, to calculate my earning per share, what is the PAT? Remember, he is asking us for current year. So I'm only looking at current information. So PAT is 14,508 minus my preference dividend of 200 divide by the number of ordinary shares, 100,000 shares. So if you guys have a calculator, you can use the calculator to calculate what is your answer for question number 1. So 14,508 minus 200 over 100,000 is equals to 1431. That means 14 cents. Okay, so 14.31, the answer is B. Number 2, the growth in the dividend for ordinary shares. So what we have to do is we need to calculate previous year dividend per share. So the prior year dividend was 7,986 divided by number of shares. So it is equals to 7,986 divided by 100,000. So this is 7.9999 cents. The current DPS will be 8585. There you see here 8585, right? 8585 divided by 100,000 is equals to, so let me use my calculator. So this is 8.59 cents. So what is the growth? So I'm going to do the growth this side. The growth is 8.59 minus 7.99 divided by 7.99. So 8.59 minus 7.99 divided by 7.99. Did you guys get the same answer as me? 7.5%. So I'm telling you, this is a simple topic. This is a straightforward topic. You actually can study it by yourself, but don't worry, I am here to guide you. I am here to make your life easy, right? Now, as for the total shareholder return, You need to know what is the dividend per share, what is the capital gains for your shares. So I already have the dividend information because I've calculated it for the previous question, part 2, right? So my current dividend is equals to, okay, 0.0859. So guys, remember, I want all information to be consistent. If my dividend is shown in the cents formula, then my price has to be in cents. If it is shown in dollar, my price has to be in dollar too. Now, for my capital gain, I'm gonna scroll up, guys. So the movement in share price is from 4.7 to 5.6. So 5.16 minus 4.7 is $0.46. So total shareholder return is equals to 0.0859 plus 0.46 divided by 4.7 prior year share price. Yeah, okay. 4.70. My total shareholder return would be, okay, let me do the calculation together with you guys. Did you get 11.6%? Right? Correct me if I'm wrong. Oops, sorry, it's a recording. So the total shareholder return is 11.6%. Now, since we have already studied the first part about the share price, you guys probably can try to do lecture example number 1. Okay, I will provide you with the answer, and also I'm going to provide you with the explanation, but I'm going to give you probably about maybe 1 to 2 minutes, okay, to try to do this question. And once you have managed to do this question, I'm going to give you the answer for this question. All right, so this answer should be B. Okay, let's read the question. Now, which of the following is the least likely explanation for the fall in the share price? Now, I just want you to remember something. The fall in the share price, any one of it can be the answer, but which is least likely to be the answer? So Banana Co has just released its financial results for the year, and its profit before tax increased by 38% over the previous year, right? So it increased by 38% profit before tax. This was due largely to a doubling of sales in the Southeast Asia. However, the share price of Banana Co fell by almost 20% immediately after the profit announcement. So why do you think the share price fell? So the sales in Southeast Asia has been expected to increase by more than 100%. An increase in sale is definitely not the reason why your share price falls. So this is wrong. Okay. The level of Banana Co's business risk has increased over the year. So the level of Banana Co's business risk has increased over the year. Maybe, but business risk increase should not affect the profit immediately. Okay, so this is not the delay in the launch of new product in the coming year. So this is going to happen in the next year. It is not something that happens now. So it will not affect profit immediately. Maybe it will affect later, but not now. So this is not the answer. Now, depreciation charge was higher. Yes, that is an answer, because if the depreciation charge is higher, the current year depreciation was higher, it will immediately affect the profit, right? So this is likely to be the answer. The others are not really the explanation, okay, because it will not immediately affect the share price. Okay, so the next part, what I'm going to do is I'm going to talk to you a little bit about the stakeholders, their objective, and how it affects the well-being of the business. And following that, we will move into the non-profit performance measurement method. Okay.